This is your February 2022 real estate and economic update, and today we are covering the jobs report, interest rates, inflation, stock market, what's going to happen next, and of course residential real estate here in Metro Detroit, which we all know and love, and I gotta say I love because I am a real estate broker here in Metro Detroit, and should you be looking to either purchase a home or sell a home, I'd be honored if you would give us a call and give us the opportunity to interview for the job. Don't forget to like and subscribe, and guys, let's start out with number one, the jobs report. So we've all heard of this thing called the Great Resignation, where a lot of people are just leaving their jobs starting in October, going through November, December, and economists completely expected a whiff on the jobs report this January, but surprisingly, the economy added 467,000 jobs in January 2022. Now, there's some good news and there's some bad news of that, right? So the good news is we are still adding jobs at a steady pace, which is awesome, which means we have an exceptionally strong economy. The downside is it is going to give Jerome Powell the green light and go ahead to start raising those interest rates to start hedging against inflation, which we're going to talk about next. But before we leave this, one thing I do want to mention is we are at the lowest it's been in the last 12 months for long-term joblessness. And that's defined as people without a job for 6 months or more. We just dropped down below 1.7 million people. But think about it, guys. In January of 2020, that number was at 4 million. So we were literally less than half, which is excellent. So Jerome Powell is 100% committing to battling inflation. Now, he's been holding off so far from some major interest rate hikes. There have been a couple of hikes, but some major interest rate hikes, waiting to make sure we've got a stable and strong economy, because the last thing he wants to do is send the economy into a tailspin. Now, as strong as our economy is, Wall Street is predicting we could have as many as 7 interest rate hikes this year. Originally coming out of November, coming out of Wyoming, Jackson Hole, we were predicting 3. Now my personal prediction is 4 interest rate hikes, the first of which happening in March, the next 3 happening subsequently in quarter 3 or 4 of this year. I think he's going to take it easy. I think he's going to raise interest rates a little bit in March, dip the toe in the water, see where we go, and then if the economy does not just completely backslide on us, then quarter 3, quarter 4, once we become used to it, those interest rates are going to go up again. Now, we have seen mortgage rates raise slightly so far this year. One thing I will mention is what most economists thought would be an 1/8 of a point raise in March is looking more and more like a 1/4 point interest rate raise here in March 2022. That means that if you have an interest rate currently on your home at or above 4%, I don't know why anybody left here does, you shouldn't, but if you do for some reason, call your local lending institution, be it your credit union or your local bank, and let's get that thing refinanced and get your payment down today, not wait. This is your last opportunity, guys. This is it. And that leads straight into inflation. January 2022, we all thought this thing was going to be the hotness express. And it's looking like it may be backing off just a little bit. We don't have all the numbers in yet, but we're looking like January might be a little bit more of a positive number for inflation. And there are a couple of reasons why. Number one, all that COVID money is starting to dry up. What had happened was the government gave out trillions of dollars of COVID money. We know this. Bank accounts ballooned. We had all the money being deposited into people's accounts to try to get them through. Unemployment actually peaked and went way low super fast, unexpectedly fast, which was awesome, by the way. So we had the biggest bank accounts people had had in over 15 years. And then all of a sudden, everything started reopening mid-2021. People wanted to go out and have experiences such as going to dinner, going and spending on retail, and all those things which happened, which completely spiked inflation as the supply chains were put to the ultimate test. But in December 2021, we saw retail spending come down 3.7%. We saw inflation continue to spike because of what had happened in November, October, and September, but now we're seeing that now that retail spending is curbing, now that people are getting back into the normal routines of spending, inflation itself is starting to balance itself out. Second reason why is because, and now this is not a great reason, but we saw rents skyrocket in 2021. In fact, they went up 14% on average across the U.S., 16.5% here in Metro Detroit. Not to mention, we saw the second most expensive thing. So living expenses is the most expensive thing that most Americans pay for. The second most expensive thing most Americans pay for are their cars. We saw used cars jump to over $25,000 for an average used car, $6,000 higher than it was 24 months ago. It was at $19,000, hovering for a couple of years. And we saw new cars jump to over $42,000 as an average for a new car, which is about $8,000 higher than it was 2 years before or more. Having those two expenses increase is compacting against disposable income, so it's actually giving Americans a lot less to work with, which means a lot less strain on the supply chains. So what I think we're going to see, especially with interest rates starting to go up in March, per the Fed. We're going to see that downward pressure on inflation. We're going to see the number actually start to tumble. Next up is the stock market. And let's be real, guys, who knows what's really going to happen? This thing has been like Mr. Toad's wild ride all January. We've got the Dow 6% down off its peak. We've got the NASDAQ 9% down off its peak. We've got literally 70% of all the stocks traded on the NASDAQ down 20% or more off their peak, and 40% of them are down 60% or more. 60%, guys, that's such a big number. Now, gratefully, those are some of the smaller stocks, not some of the bigger companies like your Amazons and your Metas and things like that. But wait, guys, there is more. In fact, on the same day, we saw Meta jump down, literally down, losing $230 billion of value in one day. Their stock dropped 24%, but on that same day, we saw Amazon jump with its single biggest day jump ever, gaining $191 billion in value in one day. So the biggest loss is bookended by the biggest gain by two of the FANG companies. Who the heck knows what's going on? Now, just before that, we saw an earnings report from Apple coming out showing that it is not having supply chain issues, in fact, and its revenue grew 30%, which is awesome, causing the stock to jump 7%. What does this all mean? This means, guys, that at the end of the day, nobody really knows what's going to happen with the stock market. We do know that almost everything is overvalued. We do know that growth is going to slow down. We're not going to see that 20 to 25% growth that we've seen these last couple of years out of the market. I think that we're going to settle into a nice and easy 7% growth. And if you watch any of my other videos, check out these two right here. Both of these cards right here are going to show you that my belief is steady Eddie. Just keep investing in that market. Again, go towards baskets of stocks like mutuals and ETFs. Do not go towards those individual stocks as we saw with Meta. But a good basket of stocks is going to mitigate against all of the risk by owning a bunch of stocks instead of just one. Again, guys, just keep on investing. Don't pay attention to all the sizzle words and all the hype. The stock market will be fine. It always is. And one more piece of stock news, which I find completely interesting, is that Microsoft is again extending further into the gaming space by its purchase of Activision Blizzard, which happened in January. Now, this is really interesting to me because right now the two biggest players in the game, and have been the biggest players in the game for a couple of decades now, are both Sony and Nintendo. You have the Sony PlayStation, all the Nintendos, the Wiis, the Switch, all of that. So those guys have been kind of the mainstay players in the game, but slowly over time, Microsoft has been buying company after company after company. With Activision Blizzard, it also gets World of Warcraft. It owns the Call of Duty. If you look at the franchises that Microsoft owns now, it is a absolutely impressive name of both games that are coming out, but also legacy games. Now, here's where it gets a little weird. So Microsoft is putting out its Game Pass at $9.99 a month to access most of these games. The thought is they're going to extend it out over all of the games that they buy. Traditionally, games have sold for $70 or $80 at the start, $50 on sale, which is what Sony and Nintendo do. The reason for this is because it costs tens of millions of dollars to make a great game. It could cost $100 million in some cases to make a great game. And to offset those costs, they have to charge $70 or $80. Microsoft, they are such a big company because if you take Sony and you take Nintendo and you combine them, Microsoft is still 12 times bigger than that. It's one of the top 5 biggest companies in the United States. They don't need to necessarily profit off this. They just want people on their ecosystem. Because unlike a lot of other companies, not only do they own the games, and with the pass they're going to get that $9.99 a month clip, they also own the platform that you're using, so it owns your Xbox, it owns the web, right, because it owns Bing, and it owns a ton of other things like the operating systems in the majority of computers. So they're looking to try to be an everything to everyone company like they were in the 90s. So this is going to be really interesting to see how this goes forward into the future in the gaming space and how much they're looking to crush out as competition. It's going to be interesting, guys. Let's keep an eye on that. And now, the moment you've been waiting for is real estate. Now, before we get there, don't forget to like to help the YouTube algorithm for this specific video, and subscribe to be notified when new videos are put out. We've got a whole slew and bevy of them coming out this spring you're not going to want to miss. Real estate, aka, I will name my next born child after you, Mr. Seller, if you sell me your house. Because that's where we're at again, right here in January 2022. See, January 2021, we saw the lowest inventory levels ever, or so we thought. Could they get any lower? Come to find out they actually can. In 2021, we saw 9,800 homes in Metro Detroit here go on the market. In 2022, in January, we saw 9,200 homes. So what's compacting the market right now, number one, is number of sellers that are going on the market is going down. And that's caused, again, part of that 12% gain year over year. And what that looks like is a home that you could have bought for $300,000 a year ago, you're now paying $336,000 for. A home that you could have bought for $700,000 a year ago, you're now paying $784,000 for. Roughly, right, guys? Area dependent, condition dependent, all of those things, of course. Number two, we have a big push of buyers going into the market right now. The Mortgage Bankers Association is showing that here in Michigan, The number of people that are applying for a loan is up 15 to 20% over the last 90 days because buyers know interest rates are on the rise and they want to take advantage of the lower interest rate as fast as possible. So these guys are running at houses as hard as possible. The third reason why we're seeing issues with 5, 10, 15, and 20 offers on a home yet again is that redheaded stepchild that's in this market right now, aka investors. And I'm an investor, so I don't want to go too hard on it, not to be too mean, but to be real. Rents jumped 14% last year. You've heard me say that a zillion times, and I want to keep on stumping that thumb because I want people to acknowledge that you have the choice of paying down a mortgage for one of two people, either yourself or a landlord. You got to pick one. I want you to pick you. I want you to understand that those rents are going to continue to go up and they're going to continue to increase at least 3 to 5% every single year while your mortgage stays steady, right? It's a fixed payment, which is good. So investors who are watching rents go up 14% nationwide, 16.5% here in Metro Detroit, are willing to pay 10, 20, 30,000 more, and they're making cash offers on these first-time seller homes. So that's the crowd that's like the $80,000 to $250,000 crowd where people are going on the market, they might be having another kid, they might need another bigger home, they're ready for that next step in life, and then swoops in cash investor, boxing out your conventional loans, your FHA loans, your VA loans, which is pretty much everybody in the market right now. That's over 90% of buyers for their own primary residences. So now you've got these sellers that are turning into buyers. They have 10, 20, 30, 40,000 more in cash than what they originally thought. They're walking into the market with a huge down payment because of the equity spikes in recent years. What they're not doing is saying, hey, let's put down a bigger down payment on a home. What they're saying is, no, let's go ahead and keep that down payment at 20% and we'll just push up the amount of home that we're going to buy. Again, further pushing those price increases. Now, we do see in February, hopefully a little bit of a loosening of this is the prediction. We're seeing some of the home sellers start to go on the market, which is good, which will loosen this up a little bit. We are still going to see in excess of 8 offers on average in Metro Detroit, but it's not going to be the 15 that we saw in January. So if you're considering buying a home, January, probably not your time, no offense, but only 1 in 6, 1 in 7, depending on what city it is, offers got accepted. Now we're going to see that go down to maybe a 1 in 4, 1 in 3. So if you're ready to buy your home, February and March could be your time. Give us a call. We would be honored to help your family, especially if you've been out in the market and you have tried making a couple of offers and been unsuccessful. We have 14 different negotiation points that we use to get people the homes that they want and not necessarily pay the most. If you're a seller in the market, we take those same negotiation points and flip them right back over because we want to maximize your equity out of your property because that's your money that you've worked hard to earn. Very important. Last but not least, I do want to show the sales price graph year over year, and not only year over year this time, but I'm going to go back 10 years because I want to show exactly how everything has changed. But last year, I do want to note that the average sales price in Metro Detroit did climb over the entirety of 2021, $48,000 on average. So if you don't think you have equity, guys, and you've owned your home for at least 12 months, guess what? You have equity. That's where we're at. So where are we going to go next with all of this? Honestly, I think we are going to start to see inflation come under control over the next 90 to 150 days, somewhere in that range. We are going to see interest rates spike up to 3.75. It's going to happen. It needs to happen to ease on the supply chains. I think the stock market that's been fluttery, we're going to see it continue to drop just a little bit, but then we're going to see a slow recovery in the second half of the year. Where are we at with crypto? I always want to mention that. Well, we saw a huge drop on that. My prediction is, and it'll probably happen by the time we get this video out, it will start to recover like everything else, and it got spooked because of what's going on in Russia and the Ukraine and everything else, and guess what? Everything gets spooked all the time. Crypto is just a newer market, so I think might have been spooked or might have spooked those investors a little more, as a lot of those investors are also younger investors and they haven't seen a market bounce yet. So I think they might have gotten a little more scared or gotten out a little earlier instead of just staying in for the whole ride, right? I think that's a mistake. If you have been considering getting out of the crypto market, my advice is let's just hang in there another couple of months and see what happens. I think we're going to see some swing backs. I don't think we'll recover 100% over the next 30 days, but over the next 6 months, I think we will, and we'll see some gains in that market. So guys, stay tuned. It's going to be a wild ride for 2022, but I'm going to ride with you. I'm going to keep you updated on what's going on in the financial and real estate markets. And again, subscribe, hit like, and make it a great day.